Great news, you have some money to invest. Now, what are you going to do with it? Do you put it all in at one time, in effect a lump sum, putting it all in at one time, or do you put it in a little bit of increments each time, maybe every week or every month? That's called dollar cost averaging or periodic averaging, depending on what type of currency you have. But which is best? Put it all in at once or just a little bit of time each time? And are there some studies that actually show whether one method is better than another? Actually, there is, and I'm going to share all that as far as understanding lump sum investing, dollar cost investing, and which one is best coming up. Hi, and welcome to the channel where we help you to learn fast so you can become confident and a very successful investor. If that sounds interesting to you, go ahead and click that subscribe button. All right, let's talk about lump sum investing versus putting it in slowly or dollar cost averaging. And at the end, we're going to talk about the advantages, disadvantages of each, but also we're going to look at a study that shows that one might be better than the other. In fact, the study does show that one is significantly better than the other. We're going to learn which one that is. But let's first understand what we mean by lump sum and dollar cost averaging, how it works and how you can use it to your advantage. So lump sum investing is basically you're investing all your money at one time, today, you're all in. So if you've got money to invest, maybe you've had saved some money you want to invest, you got inheritance, whatever, you've got some money to invest, you're going to put it all in at one time. That's the idea of lump sum investing. It all goes in at one time, which can feel a little risky, right? It can be a little scary. It's like, oh, this is my money I just got. I got a bonus at work. Now I want to have some money to invest. Do I put it all at one time? Well, that's the lump sum part of it. Or maybe you want something that feels a little better for less risk or spreading that risk up because the markets go up and down. What if I'm buying at high? Shouldn't I kind of spread that out? Well, that's the other option, which is dollar cost averaging or putting it in periodically. So if we look at dollar cost averaging, an example, a common way to do it is to take that money and spread it out over certain periods. Like in this example, we're going to invest maybe we've got a total amount of money and we're going to invest it over 5 months. A little bit each month over 5 months is the idea here. In this particular example, you could do it over 5 weeks. You could do it over a year. You could do it a lot of different ways. But the idea is that you're doing it in regular intervals and a little bit each time in regular intervals. So let's use an example here on dollar cost averaging. Let's say you've got a nice bonus at work or you came into some money and you have $5,000 you want to invest, right? You have $5,000, whatever your currency equivalent is, $5,000 you want to invest. Now the lump sum would be, we invest it all at one time. Dollar cost average, let's say you can spread that out. So let's say we want to spread it out over 5 months. So every month for 5 months, we're going to put in, 1/5 each month, which would be $1,000, right? Every month until we get through 5 months, and our total $5,000 is now invested. And let's say we want to buy some stock, doing that. We want to buy some stock, the same stock as we're periodically putting that in. So let's take a look at that from an example and from a chart, using a chart for that to really help. So you can see here on the left, we've got our different months that we're investing, January, February, March, April. We're going to put the same $1,000, that's the dollar cost or the average amount we're putting in every single time. The stock price fluctuates every month. So you can see in that column how the stock price is, sometimes it's up, sometimes it's down. And depending on what that stock price is, we're going to buy more shares or less shares in the far right column, because we're still going to invest $1,000 irregardless of what the stock price is, but we'll end up getting more or less shares depending on whether it's above or below. In this case, like we're going to start with $20. So if we buy a stock at $20 and we want to spend $1,000, we buy 50 shares. You can see in February, the stock price went up a little bit. So now we're getting less shares. March, the price went down. That's, we're buying now cheap, right? So, because we're now at $18 a share instead of $20 a share if we would put everything in at the same time. So we're getting more shares. Same in April, we're getting more shares because the price is lower. And then it went above $20. So in May, we're getting less shares than if we would have done everything in January at $20 a share. So you can see we're buying over a period of time and we're getting different amounts of prices on each of the different shares that we're investing in. And the idea behind that is we're trying to spread out our risk. We're not buying at one part. We're spreading that out over 5 months. So if we had invested $5,000 in total and we purchased so we have invested $5,000 in total and we purchased 253.4 shares using this example for a dollar cost average stock price of $19.73. We've averaged out at $19.73 per share of stock. So in this case, it was better than lump sum buying of 250 shares right away at that $20 per share, or spending the whole $5,000 back in January. Now, it doesn't always work out that way, of course. Sometimes it would have been better if we would have bought everything in January in this example. But it's the idea of spreading out that risk. And that's really what the real core part of dollar cost averaging is it's spreading out that risk over several months. Whether the stock's going up or down, you're buying at the same time and you're averaging your way in versus putting it all in at one lump sum. And so when the market's up, you're buying a little less, and when the market's down, you're buying a little more, and you're spreading out that risk. In the United States, we have 401ks, like through work, right? So 401k program where they're taking a little bit of money out each paycheck that you have, and you're using that in your investments. That essentially is dollar cost averaging. So if you're wondering about, well, what is dollar cost averaging? Think of your 401k or other types of investments through your company where they're taking money out of your paycheck with that periodical investing no matter where you live. But in USA, that's a 401k. So lump sum investing gives you your investments or your money exposure to the market right away. It gives it to you sooner rather than having it be sitting in cash waiting to be spread out over 5 months. Now remember, cash is very, very low returns, extremely low interest rates on cash. So it's not going to keep up with inflation, inflation being rising prices. Prices are always going up. So your cash account's not going to keep up with that inflation. So one advantage of lump sum investing is putting it all in, then you're getting to work sooner in the market. And the market, like say the stock market, is going to do better than inflation is the idea, and your investments will grow over time. So that's the advantage of lump sum investing. So the biggest determiner for most folks, whether they want to put that $5,000 or whatever amount of money you have to invest in one as a lump sum or to spread it out using dollar cost average, the really determiner is your feeling on risk. What do you feel comfortable with? Do you feel comfortable just kind of pushing all your chips in now, so to speak? Or do you like that idea of spreading it out a little bit and you're doing a little bit each time? So that's really the big determinant, and only you can answer that question. If you want to try to spread out that risk, then that dollar cost averaging might be the way for you to go. If you want to get in the market sooner and let it work even sooner, then maybe that's where a lump sum would be best for you. But what does the research say? Has there been a company, has there been some research around this that says, well, is one way better than another from an actual mathematical and historical return standpoint? And the answer is yes. Actually, Vanguard did a very exhaustive research around this years ago, and it actually determined that one way is better than another. So let's take a look at that research and see what the research says. So the Vanguard research study around dollar cost averaging and lump sum investing is pretty much the gold standard, what most people refer to. If there's some newer ones, great. Maybe put in the comments if you know of a newer one, probably going to follow the same lines. But Vanguard basically looked at the USA, UK, and Australian markets, right? And the interesting thing is all the results or the returns was consistent across all three markets, so it was very consistent. And they examined rolling 10-year periods from 1926 to 2011. This research was done a while ago, back in 2012, but I think it still holds today. But they were looking at these 10-year periods, whether somebody invested as a lump sum or dollar cost average. And so they examined these different periods. And so they examined these they used a rolling increments by months. So they ended up examining 1,000 different 10-year rolling periods. So they got a lot of data from that in terms of, when you're investing from a dollar cost averaging standpoint over this really long period of time to try to get some good data coming out on this. They looked at different stock and bond allocations. So it wasn't all just stocks or something. They had different allocations to see if maybe it worked better for some allocations and less so for others. It really didn't turn out that way, but they did do it that way. And for dollar cost averaging, they looked at periods ranging from 6 to 36 months. So like in our example, we were using 5 months. This was looking at periods from 6 to 36 months. And so they did all this exhaustive research as far as what did happen in the past. And of course, as you see all over, like on mutual fund websites, they'll say past performance does not guarantee future results, which is true. But it is instructive to look at what the data is telling us, especially when something's this exhaustive, to see, if there's anything that's maybe showing. And there was some definite results, significant results. And so the results were that lump sum investing actually beat dollar cost averaging about 2/3 of the time. So that means that 2/3 of the time over all these different rolling 10-year periods, you would have been better off doing a lump sum and pushing all your money in versus spreading it out either over 6 or up to 36 months. They tried it all those different intervals over these different rolling 10-year periods. So the answer from a mathematical and historical standpoint and data standpoint and research standpoint would be, the answer is lump sum investing. However, again, we're human beings. And so if you like that idea of spreading out that risk or putting a little bit each time, if you're disciplined and can put in each level of time, it's still not significant enough as far as a difference, but you might feel better and actually invest it in a better way than if you spread it out over time. Or it's maybe when you get the money available to you. That's where it comes back to the 401k or taking the money of your paycheck. You don't have the money available to you until you get your paycheck. So then you're going to dollar cost average it anyways, and that's okay. But if you come into some money and you have some money that you want to invest in, one, you could either do as a lump sum as a big chunk or average it out. The research says put it all in as a lump sum. It may go down initially, but over time it should hopefully rise. That's the idea of investing. And by getting in the market sooner, you actually end up with better returns, particularly if you start considering things like inflation during the period of when that investing is running. So if you dollar cost, let's say we took our $5,000 example and spread that out over 36 months, well, now it's a really long spread out. And that's, inflation might become a little bit more impactful because it's such a long period of time. So either way works. The biggest thing you can do is to invest it. Whether you do it as a lump sum or dollar cost average, if you spend the money, then it's gone, right? The money's gone, it's been spent. So if you want to invest the money, the key is to invest it. So either way works actually, but 2/3 of the time lump sum turns out better from the research. All right, there you have it. You understand lump sum and dollar cost averaging, a little bit around the research. If you have some comments on that, put it in the comments below. Love to hear from you as far as your thoughts on that, one you use or one that you like or what might sound better to you. Throw it in the comments. If you like this video, give it a like. And hey, don't forget to hit that subscribe button to check out more videos that we have here from Investing Education with me, Mr. B. With that, I wish you all the best of luck in your investing journey, whether you're going as a lump or a dollar cost average. Keep investing. It'll turn out great for you in the long run.